Hey everyone, welcome back to Chipstock Investor. It's Nick and Kasey, and it's the day after Nvidia earnings.
Let's get right to it. You probably already heard all the hot takes and how it was just not that great of a report. Maybe the market's going down now.
Let's see for ourselves. Now, you're probably very familiar with this slide, Nvidia quarterly revenue breakdown. Data center, of course, is the biggest, and then they also have it broken out by gaming, professional visualization, auto, OEM, and other. Total revenue for the quarter was over $46 billion, closer to $47 billion. That revenue coming in just about $2.7 billion over last quarter. So we've been used to seeing around $4 to $5 billion a quarter extra. What happened this quarter?
Nvidia told us to expect this. They said that they weren't going to log any sales from those H20 chips to China. And in fact, when we talk about the guidance for Q3, there's no revenue from data center sales to China either. So we did update our end market sales chart earlier this year for the semiconductor industry. We said that there was going to be a re-acceleration of growth for accelerated computing and AI infrastructure. And if you exclude the impact from the loss of sales to China, that is in fact what is actually happening. Because the revenue outlook for Q3 was
$54 billion.
Yeah, okay. So $8 to $9 billion sequential quarter-over-quarter increase. I think NVIDIA is going to be okay.
Before we take a look at some of the earnings call highlights, quick shout out to our friends over at fiscal.ai and the sponsor of today's video. This is one of the charts that we made for today's video using fiscal.ai regarding hyperscaler CapEx. We'll expand on this a little bit more in the video, but fiscal.ai helps you make cool charts like this one. You can get 15% off any paid plan, as well as a new enterprise plan for you pros out there or aspiring pros. 15% off with the link in our video description or here on the screen, fiscal.ai/CSI. Let's take a look at these earnings call highlights.
Yeah, we took some notes during the call yesterday afternoon. And if you want to just pause the video and take a look at these, go ahead and do so right now. We've got a second slide for the Q&A portion, but two big points we want to make here before talking about that hyperscaler capital expenditure chart. The Blackwell production is now at 1,000 racks per week or more, and that number will accelerate through the second half of this year. And then what about next year? Post Blackwell, we're all waiting for Rubin, the successor.
Rubin is on track to begin next year volume production, so something to look forward to. But we'll get more information on this at GTC 2026 in March. We'll just have to be patient.
Yeah, another 6 months. I think we have plenty to talk about here with NVIDIA before we get too excited about Rubin.
But of course, one of the biggest questions that keeps coming up is CapEx spending from the customers of NVIDIA, the hyperscalers in particular. They're spending a lot of coin to buy these latest and greatest GPUs. When is that going to end?
Jensen was asked about this on the Q&A section, and he remarked that over the last 2 years, that hyperscaler CapEx has doubled. And in fact, it's more than doubled, as you'll see again when we show you this chart, to $600 billion total spent on AI data centers. Or maybe we should just say more broadly, accelerated computing data centers. And Jensen said he actually expects the total CapEx spend to reach $3 to $4 trillion by 2030, and said that that was a fairly sensible estimate, at least in his estimation.
He even went on to say that next year they expect to be another record-breaking year for NVIDIA.
And that kind of jives with what the hyperscalers themselves have said. Record CapEx spend this year, especially in the last 3 quarters, and they expect it to ratchet up higher the second half of 2025 and into calendar year 2026. And if you tally these numbers up, you'll see that it's actually more like just over $500 billion in CapEx spent from Amazon, Microsoft, Google, Meta, and Oracle over the last trailing 2-year period. So it seems like $3 to $4 trillion total in CapEx spent. That seems like a really crazy number. But if you sort of just froze this pace of CapEx spending where it's been at for the last, let's say the last 4 quarters, and forecast this out over the next 5 years to 2030, that actually gets you to that $3 trillion estimate that Jensen mentioned. So maybe that isn't such a crazy number, and that could factor for perhaps a bit of a ramp up in CapEx spend next year, maybe a cyclical downturn in CapEx spend at some point, maybe in 2027, maybe some enterprises and other companies ratcheting up their spend on accelerated compute to pick up the slack. At any rate, we think it is maybe actually a sensible estimate.
But what about the argument regarding hyperscalers getting the return on investment that they need from all of these GPU purchases? Let's take a look at the free cash flow for these hyperscalers. And obviously, in the last few quarters, you can see that it has drawn down a bit because of those capital expenditures.
Yes, that's true. But given how much the CapEx has increased, you might otherwise have expected to see this number actually look a lot worse than it actually has been. As we've talked about multiple times, when this CapEx cycle eventually comes to an end or moderates, the free cash flow for these large data center operators is going to go up quite dramatically. We can contrast this with a look at the GAAP net income for these same companies.
Generally speaking, the GAAP net income for these companies has been up and to the right. You can obviously see some stagnation there over the last few quarters because of, among other things, depreciation of those assets.
That said, the capital expense has already been made, so the depreciation really, that's an issue related to tax liability. The US government doesn't let companies write off big purchases all at once. It has to be depreciated over the course of 5 years. So all things being equal, we expect GAAP net income to begin to tick higher again later this year and into next. These companies are reporting that they are getting good revenue increases from their purchases of accelerated computing systems. They're experimenting with lots of new products that could bring in even more revenue later on. Cloud is still a secular growth trend. At least as far as we can tell at this point, all looks fine and well for the hyperscalers, and all of this bodes well for Nvidia too.
But here at Chipstock Investor, we've chosen to not only have Nvidia in our portfolio, but some of these hyperscalers as well, to sort of have a soft hedge against Nvidia, because yes, eventually the CapEx spending cycle will slow down, profitability will increase for these companies, free cash flow will increase, and that may be not so great for Nvidia. We don't know what Nvidia has up their sleeve next. They could shift that revenue to some other end markets as well. But having both in our portfolio makes us feel a little better and helps us sleep at night.
Yep, that's right. What's great for Nvidia right now, maybe not so great for the hyperscalers, but the cycle will flip. And this is just the natural order of how the market works.
Thanks everybody for watching this video today. Check us out over on chipstockinvestor.com. We have a semiconductor insider membership that gets you access to all of our articles, research, live events, all the good stuff. Link here in the video and in the description below, chipstockinvestor.com. See y'all later.